Now, if Congress can't get its act together on the deficit, it may be up to the bond market to enforce some discipline. The question, though, is when. Here to answer it is Joe Balestrino. He's the chief market strategist for fixed income at Federated Investors with assets under management of $15 billion. Joe, the bond market was supposed to enforce this discipline back in August when America lost its AAA credit rating. What happened? Bond yields continued to go down. So when do the bond vigilantes show up?
You're right, Eric. And bonds aren't supposed to be this exciting, but they have been. When do they show up? Not for a little while yet. Interest rates go up for two reasons. One is things are better, and obviously things are not quite better yet. The other reason is the reason we don't want to think about it. And that's when we cross the line from being an interest rate market to a credit market. Things Spain a couple of years ago. That's really when it occurs, with a vengeance. The downgrade is just exacerbating the fact that we are the safe haven, despite all of our criticisms. Mostly self-induced. We are the safe haven asset class.
Do you think the bond market will start to sell off in a meaningful way before that November 23rd date?
Honestly, I do not. In fact, I'm not sure the November 23rd date, 20th date, whatever date the bond market recognizes it, I don't think it recognizes it very much. We've been through this with the debt ceiling. At the end of the day,
no discipline, in other words. So those of us who are counting on investors like yourself to force Congress to do something shouldn't be holding out any hope.
I don't think so. It's about expectations. Unfortunately, I don't think any of us on the bond side expect much progress. We expect them to punt it back, maybe do half of the minimum requirement, and then it's back to the president, and essentially the defense budget gets cut.
Joe, let's go back to the comment that you made just a couple of moments ago, when the U.S. goes from being a risk-free market to a credit market. What do you mean by that?
That's a bad scenario. That's a line one does not want to cross. That means simply interest rates go up because we become a higher credit risk, higher default risk. So today we are
a default risk akin to what, I guess, is what I need to ask you. Well, what would you compare it to?
Not default in the sense that we won't pay our obligations. Credit risk in the sense that we are a higher risk credit. We simply have too much debt relative to the size of our economy. It's like a corporate bond getting downgraded.
So 2-3 years down the road, what are people going to be comparing the United States to?
It's the next safe haven, and that's a tough one to define. I would suggest the next safe haven investments in our business, even away from bonds, is what we refer to today as the emerging markets. It is the entity creating a surplus.
And the U.S. becomes what, Spain?
We become on a track towards Spain. Now, Spain's a lot
towards Spain.
Well, they're a lot worse than we are. Their unemployment rate's more than twice.
That's pretty extraordinary.
It's extraordinary, but I think it's unavoidable. Now, don't get too far down the line, but the deficit hole we've dug is too deep to simply, grow our way out of it like we did in the 90s.
Does that mean, Joe, that the historic bond market rally that sent the 10-year yield down to 1.72% is over?
It is over. I believe it is over. And you and I have talked about having that opportunity a couple of times. I don't think we get a third chance to sell bonds in the 160s. I do think we see it one handle. Frankly, we could see it today. But to get all the way down there suggests Europe has no semblance of any, I won't use the word recovery, but any fix on the fiscal side. And they do have a sense. Whether they have the will is another factor.
Well, you are right. We could see it today. The 10-year yield at 207 right now. Joe, great to see you. Some great perspective on America becoming a credit market. Think about that. Treasuries, a credit market. Joe Balestrino, the chief fixed income strategist at Federated Investors.